There's no exhaustive list of factors that determine your investment returns. When you ask professional investors, they'll probably jump to factors such as sentiment, interest rates, and the economy. All these factors are very relevant. But in this video, we're going to try and focus on some of the biggest factors that influence the growth of your nest egg. The factors we're going to discuss in this video are savings rate, time horizon, your asset allocation, investment fees and taxes, and your emotional behavior as an investor. Now let's go over each factor and discuss how they can be optimized to grow your wealth. Savings rate. Your savings rate is the measure of the amount of money you put aside for investment. Simply put, if you set aside more money for your investments and have the proper risk tolerance, behavioral tendencies, and budgeting, you'll end up with a larger net worth over time. To optimize this factor and get the most out of your money, you have to cut down on expenses that can wait, limit or eliminate impulse purchases, and make sure to have an emergency fund. So the first step is to track your expenses every month. Your monthly bank statement will help you see where your money is going, show you areas where you can cut expenses, and what expenses you can eliminate entirely. All of this will improve your finances by being more resourceful in meeting your daily wants and needs. The biggest deterrent to a high savings rate is expenses. And for a lot of people, that shows itself as impulse shopping. It's time you implement a time-based rule. Here's how it works. If you want to buy an item, commit to waiting some designated length of time. This could be 48 hours, a week, or even a month before you purchase. During this waiting period, you might realize you don't actually want the item, or you might find out that it's just a nice idea that's not worth the trouble of going back to buy. If after that delay you still want it, then buy it. Chances are you really need it, but many times you'll find that you can live without it. Now, you safely cut or limit these expenses and channel the money into your investments to boost your returns. Time horizon. How long your investments compound, in other words, your time horizon, is another factor that impacts your investments in a number of ways. First, how early you invest allows the magic of compounding interest to work for you, and the longer you invest allows the compounding effect to deliver more over time. This is the biggest reason you have to take a long-term approach to investing. Secondly, if you have a general idea of your time horizon, you'll have a better sense of what type of investment vehicles to consider and which to avoid. For instance, if you're saving for college and you have a newborn, you may invest in riskier, more aggressive investments because you have nearly 20 years for the money to be held. But if you're 3 years from retirement, your investments would be much more conservative. To get the most out of this factor, assuming you have your emergency fund and have your spending under control, then just start investing as soon as you can. Remember that volatility is usually a greater risk in the short term, so your investment choices should reflect this. Just don't try to time the market. Create an investment plan and stick to it. Asset allocation. The choices you make between different asset classes can have a major impact on your investment, whether you invested in real estate, stock, bonds, or cash. How much of your money you invest in each of these specific investments has a significant influence on your overall investment returns. For example, if you invested all your money into bonds, chances are your long-term returns on your investments are most likely lower than an account with a mix of equities and bonds. Bonds, while generally considered more conservative, are also less risky. This typically implies that while they may not fall drastically in comparison to equities, they typically won't outperform them. To optimize this factor to your advantage, define your investment goals and your risk tolerance. This will not only help you determine your asset allocation, but also how long you plan to keep your money invested. General advice when considering long-term investments is at least 10 years, preferably no less than 15. In this case, you may find that having stocks, although riskier than bonds, to be preferable. But if you see yourself needing your money sometime within 10 years, or you just don't know if you could weather the down times without panic selling, then you might want to reduce the percentage of your investments in equities and build your portfolio around bonds and other less volatile asset classes. This may mean your returns could be lower, but at least you'd sleep better at night. Fees. Fees you pay for your investment usually cut down on the overall value. A typical 1% fee ratio means that owning that investment will cost you 1% of the value of your entire investment each year, regardless of if you make or lose money. Now, this percentage may appear small until you consider the implications over a long period of time. For instance, you pay a 1% fee on your $100,000 investment over the course of 10 years with a rate of return around 7%. At the end of the decade, you'll have just under $180,000, but you'll have paid almost $20K in fees. Over time, these fees can have a huge impact on your overall net worth, especially when you consider other fees like withdrawal fees you pay if you withdraw outside your stipulated time frame, trading costs in the form of a bid-ask spread when you enter and leave positions too frequently, and other fees associated with account maintenance or trading strategies. So you want to keep these fees as low as possible. You do this by eliminating unnecessary trading and deciding on funds that have the lowest fee ratios, unless you're pretty sure that your investment returns will be able to outperform the fees by a wide enough margin to make you profitable. Taxes. These taxes include the tax you pay on your capital gains and short or long-term dividend tax, usually referred to as interest income tax. There are also retirement tax penalties that people incur when they withdraw money from their tax advantage account earlier than agreed, and the turnover-related taxes you pay when you own a fund that sells investments within the fund for a gain. To reduce these taxes as much as you can, consider investing in a tax advantage account, such as your IRA or 401k through your employer. If you choose a taxable account, consider holding your investments for at least a year plus 1 day before selling them for profit. Long-term capital gains are taxed at a lower rate than earned income. And as always, we are not financial advisors, so don't be afraid to reach out to a tax professional so they can look at your individual situation. Rate of return. This may be the second most important factor in determining your overall portfolio value. As you've probably guessed, with higher returns comes a larger investment portfolio. The issue is that you don't have total control over this, but you typically can choose between conservative and aggressive investments, which would have comparatively different rates of return. A higher return correlates with higher risks. In the same way, lower returns are associated with safer or more conservative investments. These two concepts define how you, as an individual investor, choose your assets and how you set your risk tolerance. To break it down, your return is the amount you expect to get back from your investment over the amount you initially put in. This is typically in the form of a percentage. For example, the stock market has historically returned an average of around 10% per year as measured by the S&P 500 index. Remember, as individual investors, we have little control over this factor, but decisions we make can have an impact. By investing more during market downturns, you're hedging your bet that the market will turn positive eventually, which it has always done in its history, so your investments would accumulate more returns on the recovery. Emotional behavior. An investor's emotional behavior is the single biggest factor that impacts an investment's performance. How an investor reacts when the world panics and the market drops to a major low, or when the market goes on a major rise, contributes to the outcome of his portfolio. Other behaviors like high-cost trading strategies, such as leveraged investments and day trading, are other common emotional responses you might encounter. Following financial media too closely is another investor behavior to be wary about. This might sound strange, but financial media often tends to focus on the present. To be a good investor, you have to start thinking long-term. You need to develop a perspective to hold on through tough times. This is important because if you focus too much on the financial media's forecast, it might lead to making decisions that you could regret. So to get the best out of your investments, you want to consider educating yourself and understanding what you want out of your portfolio. This way, you can build a financial plan that you'll be able to stick to when times get tough. In the end, what determines your investment is a combination of all of these. It's your ability to save and invest, your ability to decide the proper asset allocation that aligns with your risk and goals, your knowledge to keep your investment expenses low, and your ability to control your emotions. But what are your thoughts? Are there additional significant factors you believe we've missed? Let us know in the comments below. Hope you learned something new, and if you enjoyed this video, share it with a friend. Don't forget to like, subscribe, and hit that bell icon. We'll see you in the next one.